Hello, hi everyone. A very good morning to all of you. How are all of you doing today? I see many of you already on the call. Yes. Oh, hi Kiran, Raj, and Santu, Bhushan, Shibu. Good morning. Hello, Mohit, and hello, Hari Krishnan. How are you? Good morning. Hi. Good morning. Okay. Hi, Kiaram, Kartikeyan, Partha, Ratan, Brijesh, Gaurav, Praveen. Good morning. Hi, Priyanshu, Mutyala. Okay, so I have many of you already. Okay, Balu, hi. Hello, Narsiman sir. Good morning. Welcome back. Hi, Sayed. Good morning. Good morning. Good morning, everyone. How are all of you doing today? There's so many of you. I'm sorry, I don't think I can say hi to all of you, but thank you so much for joining in today. And truly, truly happy to be doing this. Again, I know we didn't do a masterclass last Sunday, but welcome back. So we're doing this masterclass after 2 weeks, and obviously we have a super interesting topic, which I'm hoping all of you are going to enjoy listening to. So we're just going to wait for another maybe a minute or so, and then we're going to start the session. So just a few this thing that in today's session I'm going to be using certain examples. So I would request all of you to don't take them as an advice or as a recommendation. Saurav, hi, you have a question. Yeah, please go ahead and ask me. Let me see if I can answer that before I start the session. And, so of course, like I said, don't take those as an advice or as a recommendation. We don't really promote any product as such. We're just going to use those examples to explain the concepts to you guys, right? This session is going to happen in English, and I'm going to do the same thing in Hindi at 12:30. Now, just a small thing for all of you that going forward from next week, we're going to be doing the masterclass only in Hindi. So we're not going to have the English masterclass. So I would request all of you to, to join in for my Hindi masterclasses from next class, from next week onwards. Okay. So yeah, I mean, did anyone have a question? Anything that you want to tell me before I start? Please feel free to let me know. Okay, anything specific? Thank you, Anilji. Thank you so much. Yes, last week I couldn't take the class. Uh, Saurav is asking how much percentage of my monthly take-home salary should I invest? So, Sauravji, I mean, there's no uh, hard and fast rule around it, but then I would say that if you're looking at starting your investments, at least start with say 20-25% of your take-home salary as your investments, and then of course, ideally you should increase it with time, but at least 20 to 25% is what you should start with. Okay, so I guess we have a decent crowd, so I'm going to start off with this. And today, of course, we're going to be talking about international investing. We're going to talk about how to invest abroad through mutual funds. I know this is a topic which a lot of people ask us about. We have done one masterclass in the past. I think it's been a while. We did this masterclass on investing abroad about 6 to 7 months back. So we thought we should touch up on this topic again because it's a topic which a lot of people are interested in. I'm sure even in today's masterclass, I have a lot of people who are listening to me for the first time. So, how many of you, this is the first masterclass? Can you just give me a yes on the comments, guys? For how many of you, this is the first masterclass? And while you guys do that, I'm just going to quickly share my screen with all of you. Yeah. Okay. Great. Yeah. So, how can I earn without investing money? So, I mean, I didn't really get your question. I would request you to be a little more specific, but okay. So, let's start off by understanding that if we have to invest abroad through mutual funds, then what are the different things that we should be looking at, right? And what are the different aspects, parameters, factors, features that we should consider while we are investing money outside of, stocks outside of India, in stocks outside of India. So now, of course, when we're looking at investing, right? I mean, what is the main objective when we are investing money? The main objective is returns, right? All of us want to generate good returns from our investments. And obviously, equity as an asset class really helps us in doing that, right? I'm sure you all agree that equity is one of those asset classes which has the potential to give us decent returns. And that is one of the reasons why a lot of us like investing in equity. But the challenge with equity again is the high volatility, right? I mean, the risk factor which is involved. And That is why, in so many of my master classes in the past, we've discussed that we need to look at diversification. We need to look at different ways of reducing that risk. So what really determines our portfolio returns, right? And how can we optimize our portfolio? If I were to look at investing in equities, generally when people are investing in equities, they focus on either selecting good stocks or good mutual funds, and they want to time the market. And most people believe that by investing in just good stocks or mutual funds and timing the market, they can actually generate great returns. But let's really see that when it comes to these two factors specifically, does it really make any difference? There's a study which said that individual stock selection and market timing accounts for less than 7% of a diversified portfolio return. So which means if you just select the right stocks and you time the market, the probability of getting high returns is less than 7%. So the big question is then, what is the key driver of portfolio return? So if I really want to look at looking at what is that one thing that I should look at which is going to help me in generating good returns, like it says, so that same study suggests that more than 91.5% of the portfolio's return is attributable to the mix of asset classes, which means if you actually invest in a combination of different asset classes, then your portfolio returns can actually be so you can actually you'll be able to generate those good returns, and at the same time your risk is going to be on the lower side. Okay, so which is why we say that a mix of asset classes, diversification, is something that we should consider. So I'm just showing you the performance of different asset classes, and I'm just going to maximize the screen for all of you so that it's a little more clear. So as all of you can see, there are different asset classes that perform at different market times, right? Now, asset classes. So what are different asset classes that we have? So we have equity, we have debt, we have gold, and we have real estate. And a combination of these could help you in generating good returns, right? So these are the options which are available. So the question is, what is the right mix? Yes. Now, while mixing two asset classes, it is important to understand that when you are putting your money into different asset classes, the performance of the options should ideally move in opposite directions. So which means the two asset classes should be negatively correlated for you to be able to balance out your risk, right? Because if you have one asset class which is doing bad, then you have the other asset class which will do well if those two asset classes are negatively correlated, right? And only then your asset allocation objective is going to be met. So if you just look at years like 2016, 18, and 19, right? So I'm just showing you these years. So 2016, 2018, and 2019. As you can see, in 2016, you had equities which underperformed in that particular year, and gold and fixed income outperformed equities. Okay, so you had gold which did well in these years, as you can see, 18 and 19. So these were the years where gold, and you had fixed income, so your GSEC, corporate bonds, credit risk, these are the asset classes which actually did well in these years. So hence they make a good choice, right? I mean, if if in a particular year equity is going down, then you have these asset classes which will make up for the loss, correct? So that is why we say that whenever you are looking at asset allocation, you should always look at diversification in terms of those asset classes which are negatively correlated. Okay. So now when we're talking about domestic and international equities. So now suppose you have invested your money in Infosys and you invested your money in Apple. Effectively speaking, you've invested in equity. So you may believe that if I've invested in these two companies' stocks, I've invested in equity. But I'll tell you the challenge. The difference is that in one company is a domestic company, which is Infosys, and the other one is an international equity that you invested in, right? So say companies like Apple, they're not listed on the Indian stock exchanges. So when you are looking at investing in these two stocks, for example, what you have to understand is that domestic equity and international equities also to a large extent move in opposite directions, more so in correlation to US. So for example, if you see US versus foreign performance, you see a negative correlation. Okay, this is why we always say that there is some form of negative correlation between domestic and international equities. And if you also look at it historically, I'm just going to change the chart for you guys. If you look at it historically, US markets and foreign markets, they have shown pretty decent degree of negative correlation, right? So if you look at this chart, which I'm showing you on the screen, and I'm again going to just maximize it for you slightly, as you can see, there is some form of negative correlation in at least, few years. Not in every year, but at least in some of the years, you see that negative correlation, right? So, which is why we always say that international investing is categorized as a separate asset class. So, when you're investing in international stock, it is considered to be a separate asset class in itself, since domestic and international equities carry some form of negative correlation, right? So, which is why if you add additional investments to the portfolio, it really, really helps in diversification. Clear? So, now let's understand what is it that we are going to look at. So, if I want to invest in international markets, what are those few things we are going to talk about, right? So, first, I'm going to tell you why we should invest in international markets. Second, I'm telling you how you can invest in international markets. What are different ways of, what are the different types of mutual funds which are available, and then I'll tell you about the tax treatment for those investments. Okay, so we're going to start off by understanding, why we should invest in international markets, and there are these three aspects I'm going to talk to you about. One is diversification, being part of global growth stories, and currency depreciation. So let's start off with diversification, or basically how is it that we can diversify our portfolio uh, by investing in international markets, and how does it help? See, when you're investing in domestic equity, right, you have that country specific risk. Yes. So I'm sure all of you agree that India is capped to be one of the fastest growing, economies in the world. A lot of globally, most of the countries are looking at us. We are expected to do well in terms of GDP and so on. We are poised to be the global leaders at some point. But there are plenty of positives, like you have post-COVID. Most of the developed countries are looking at China plus one policy, right? Which I'm sure a lot of you would have heard of, where manufacturing is going to be shifted to other countries outside of China. That's why it's called the China plus one policy. And India is really expected to benefit from this whole, from this whole scenario. But at the same time, there are certain country-specific risks which are there in every country, including India. So, for example, there is whether you invest in a particular stock, you invest in a mutual fund, as long as you're investing in equities, you will have that risk which will be applicable to you, which we call as a country specific risk. So if you look at, say, 3 to 4 years before COVID, right, we had companies that didn't do so well and didn't even meet the earning expectations because we had a lot of systemic shocks in the system. So we call, so things like demonetization, GST, all these, new things which were introduced, because of which what happened was there were a lot of systemic shocks. And if something like that happens, it impacts everyone. It's not like it's impacting one company or one particular asset class. It pretty much impacts everyone. So what happens is that country specific risk is what we call a systemic risk or systematic risk, which we cannot avoid no matter what. So I can tell you diversify, invest for long term. I can tell you like 10 things to do to reduce your risk. But if there's a country specific risk, we cannot avoid it. Okay. So if you want to really try to manage that country specific risk, then what do? Then obviously you look for diversification in the international markets. Now, why is it that if we invest in US and other developed markets, what would happen, right? So if you look at US and other developed markets, they're too big to ignore. You cannot ignore these markets because these markets are so big in terms of market cap that they will be a part of your life at some point or the other, right? US alone contributes to about 40% of global equity market. So US alone, if you look at the global equity market, US alone contributes to about 40%. And if you put together US with other developed markets, it's close to 80%. Okay. So just developed markets are contributing 80% to global equities. Yes. And if you look at companies like, say, Amazon, Microsoft, all these, they are at a market capitalization of, say, more than $1 trillion, right? Now, their presence is not just in US, they are present across the globe, correct? So then, of course, people talk about the post-COVID tech boom, and they're probably saying that, companies like Amazon and Microsoft are going to benefit from it, which is true. But if you just look at the combined market cap of all the stocks in the Dow Jones today, right? So basically, the complete market capitalization of all the stocks on Dow Jones, that's about $8.33 trillion, which is nearly 8 times the combined market capitalization of all the stocks on BSC Sensex, which is about $1.16 trillion. Okay. So The US Dow Jones is 8 times that of Sensex. Now that's the kind of size that that we are looking at. So, which is why we always say that when we are looking at diversification, it always helps when you are adding countries which are which move, whose indices move negative or in negative correlation to our indices. Simple, right? So that adding those US related investments are going to add value to our diversification, because even developed markets, emerging markets, they all go through their cycles, right? And investing in developed markets would help you diversify that risk. Now, the second scenario, second reason why we should invest in these companies or international markets. So I'm sure all of you agree we live in a global world, correct? It's not like today we can live in a world where we are isolated from other countries. Today we live in a world where something happens in one part of the world, it is going to impact everyone. Yes. So when we're living in a global world, we are consuming global products. We are not consuming only our country specific domestic products, correct? So today, if you look at likes of say Facebook, Apple, Google, Netflix, Coca-Cola, Ford, Volkswagen, all these brands that we are using on a day-to-day basis are not Indian companies. They're all international companies. They're all foreign brands which function in India, right? Now, they are these companies which impact or which touch our lives on a daily basis. So, if you think that these companies are good and they make a good investment opportunity, then you can't invest in them through the Indian because they're not listed on the Indian stock exchange. So then you have to invest in them outside, right? So, let me just give you an example. So, for example, if you just look at Apple products, yes, Apple is one of the biggest companies in the world. They have been innovating regularly, right? From the Macintosh to iPods to iPads and iPhones and MacBooks and whatnot. They have really created this formidable position for themselves. Now, don't you think you would want to be a part of a growth story of a company like that, right? As of Jan 2022, the market capitalization of Apple was about $3 trillion. Just Apple alone was $3 trillion. The total size of Indian economy today is less than $3 trillion. That's the kind of size that we're talking about. So when you have companies like these, then and if you want to be a part of that growth story, the growth chart that you see, then it's quite crazy, honestly, right? Then you don't have much of an option. Yeah. And it's not really just about say tech companies, right? We have so many other sectors, so many other big companies in other sectors which are doing exceptionally well, right? So these are of course the fine companies, but apart from that, if you look at say pharma sector, right, you have so many big companies in the pharma space, and pharma as a sector is of course expected to do exceptionally well going forward, all thanks to the COVID vaccine, right? I mean, if you look at say companies like your J&J, Pfizer, Moderna, who are actually in the race for the COVID vaccine, COVID vaccination, then think about these companies and how much they're going to grow in the times to come. So, COVID vaccine alone, by the way, is expected to touch a $20 billion mark by in terms of market size by 2026. So, all these companies are obviously going to grow along with this. So you may want to be a part of these companies which are functioning in a different sector. After pharma, look at the semiconductor space. I mean, today with the whole world working from home, with everyone using computers, using phones, using everything to really manage their work and manage their life, semiconductor demand has gone up drastically, and there's a huge demand and there's not as much supply. So you have all these semiconductor companies which are actually struggling to manufacture more and more semiconductors, right? If you just look at the semiconductor, of course, like I said, because of the tech boom, it is quite crazy in terms of the semiconductor demand, and it is, it is used in automobiles, it's used in most of our electronic products. So fulfilling this new demand is going to help these companies grow in the future, right? So which is why we always say that whenever we are looking at investing in international markets, don't look at only the tech stocks. Of course, the tech companies, the tech stocks are great, but then we also have a lot of other sectors which are expected to do very, very well in times to come. And you could be a part of their growth stories as well by investing in their stocks. Yeah. Now, the third scenario, which I think is super interesting, is managing currency depreciation risk, right? Now, a lot of you would be wondering, why does currency depreciate, right? I'm sure this is a question many people have, that we hear this word, currency has depreciated, but why does it depreciate? What exactly is happening, right? So let me give you a very simple way of. Let me explain in a very simple way. Now, every time economy is in trouble, right? So every time there's some big problem with the economy, what happens is you'll have the central banks and you'll have the government who will step in to support the economy. And how will they do it? They'll basically pump in money into the economy. So we call it quantitative easing. I've used it. I've used this term. I've explained it many times in my previous class as well. In very simple terms, quantitative easing is nothing but printing of notes, right? So if you're printing new currency, that's called quantitative easing, okay? And lowering the interest rate. So if you lower the interest rate, so central bank would lower the interest rate, and if they print more currency, what would happen is there'll be more money which will be floating into the economy. That means there's more liquidity in the market. But these measures are really very short term measures to bring up the economy, right? At some point, you will have to really, bring up the interest rates, slow down quantitative easing. You can't do it forever. You can't keep printing notes all through, right? You do it for a particular phase just to come out of that particular recessionary scenario or a downturn in the economy. But you can't do it all your life, right? You have to stop somewhere, because if you keep doing that, if you keep printing notes, if the interest rates on the lower side the whole time, then inflation is going to shoot up. And you have to, any economy, any country, they have to manage their inflation very, very effectively, correct? So what would happen is, like I said, whenever the economy is not doing well, the interest rates are going to go down. But at some point, when the interest rates start going up and you will see quantitative easing coming down, that is the time you will see that the currency depreciation happens. That is the time when the currency value starts going down, okay? Because the liquidity in the market has gone down. And currency depreciation, increase in crude oil prices, higher inflation, all these, they tend to impact emerging markets more than the other developed markets. So emerging markets would land up giving lower returns compared to developed markets, especially US. So especially if you compare emerging markets to US, emerging markets will definitely give lower returns, okay? So I'll explain this with an example. All of us know 2008, right? All of us understand what happened in 2008 when we had recession. So of course, it was not just economically, but even the stock markets were doing bad. The Sensex went down by 50% and so on. And the same measures were taken to support the economy. Government lowered the interest rates, increased quantitative easing, which basically means they printed more notes. And by the end of 2008, there was enough liquidity which was pumped into the system, which really took up the equity market. So 2009 equity markets went up again. So that was a good thing at that particular point in time. It was a good thing that the government stepped in to really, increase liquidity in the market. But now by 2013, now you can't keep doing this all your life, like I said. By 2013, US markets decided that it was time to reduce quantitative easing. So US does a lot of quantitative easing, right? So US decided in 2013 that now we are going to reduce quantitative easing and we're going to increase the interest rates. Now, this made developing markets like the Indian markets very, very vulnerable. So if you guys can see this chart, okay, I'm just going to maximize it for you again. This is actually a 2003 chart from April till August. And what happened in that particular time was that there was reverse flow of money from emerging markets to the US and other developed markets. And our rupees started depreciating compared to the dollar. So, at the beginning of 2013, USD to INR exchange rate was close to 54 rupees per dollar. By the end of August 2013, which is just in about 8 months, the rupee touched 68 rupees per dollar. So that means our currency depreciated by almost 26% in just a span of 8 months. And obviously, once that happens, you'll have a lot of other impact, right? Your current account deficit increases, your inflation goes up, and so on, and which obviously has an adverse effect on the economy. So the Indian markets were impacted, and the large caps were not really impacted to a great extent, but mid caps in that 1 year corrected almost 25%, and we had small caps which corrected about 30% between Jan 2013 till August 2013, and that was the effect of this, the tapering that happened. So if you just look at this, so which is our from Jan 2013 till August 2013, if you look at the performance of Sensex and midcap versus the Dow Jones and Nasdaq, right? So as you can see, a negative correlation, correct? So you see, if you can just see here. So here we have BSE, the red bars. This is Sensex, this is BSE midcap, this is our Dow Jones, and this is Nasdaq. So as you can see, where the Indian indices have all given negative returns, we have Dow Jones and Nasdaq which have given positive returns. So they have moved in opposite directions. So had we invested in the American markets at that particular point in time, that currency depreciation we could have managed pretty effectively, right, in terms of managing our portfolio. So that, like I always say, then investing in international markets is, you look at these three reasons, of course, because you want to diversify, you want to avoid the country specific risk. At the same time, you want to be a part of those growth stories, those big companies that we consume on a regular basis, and we want to be a part of their growth stories. And of course, to really manage the currency depreciation. So now let's see that if I want to invest in international markets, I'm convinced about investing in international markets, then how do I go about investing? So what are the different ways of investing in international markets? So there are three different, if you're looking at investing through mutual funds, then there are three different types of mutual funds that you could look at. One is actively managed funds. So we have fund of funds, and then we have active international funds, and then we have passive funds. And I'm going to talk about each of them now going forward in the next, say, half an hour or so. Okay. So we're going to start with the fund of funds. So fund of fund basically is a fund which invests in another international fund or a combination of different funds. So a mutual fund which invests in another mutual fund is a fund of fund, and the fund into which you are investing is also called a feeder fund. Okay, so let's understand this little bit more in detail. So like I said, a fund of fund is investing, it is basically collecting money from the investors, and then that particular fund is investing its money into another mutual fund scheme, one or multiple schemes. They could so it's not like it's only limited to one, two, or three. It depends on the fund manager, right? Now, one of the most common and the old ways of investing in international markets, like I said, is by investing in mutual funds of the target countries. Okay. So a fund of fund would collect money into the fund of the domestic country, and it would invest into a target fund of a foreign country, which we also call as feeder fund. The earliest example that we have in India of a feeder fund was way back in 2008. We had the AIG and DSP World Gold Fund. Okay, that was the fund of funds that we had. And the most recent example that we have is the DSP Global Innovation Fund. Now, what is this DSP Global Innovation Fund? So this fund basically helps, the aim of this fund is to invest in other mutual fund schemes, which in turn follow the innovation theme. Okay, so any mutual fund scheme which is following the innovation theme, so it's investing in basically a thematic fund, but which is following the innovation theme, which is very important. So it aims to, that particular thematic fund should aim to invest in, say, sectors or companies which are very innovation oriented, but such opportunities which are not present in India. Okay, so for example, what are some of the opportunities which are not present in India? So you have things like 5G, gene technology, semiconductors, then you have robotic and automation, etc. All these are some of the opportunities which are not available in India. And if you want to be a part of these opportunities, then you could invest in a fund which is even in turn investing in the global opportunities that are available in this particular space. So like I always say, even though the money is actually invested in other mutual fund schemes, there's active fund management which is happening, right? Because the fund managers are selecting the right funds which are available to them. There are multiple funds which are available, and the fund manager is selecting the right fund. So now, which is why these funds are called active international funds. Okay, I mean, they are basically active fund of funds. So whenever we are looking at these funds, now there's another fund in this particular category. That fund is basically HDFC Developed Indexes Fund of Fund. Now, what does this do? This fund of fund, it gives you exposure, gives an exposure to the investor to invest in 23 developed markets. Okay, 23 developed markets across, with the coverage of 56% of global GDP. So, which means if you invest in this particular fund, you would have indirectly invested in 23 developed economies and covered 56% of global GDP, right? Now, this is achieved. So, how do they manage it? It's achieved through by investing in ETFs, exchange traded funds, and index funds of those countries. So, if you just look at it, so obviously here this particular fund is tracking the MSCI index, the MSCI World Index, and it is investing across large and mid cap stocks. So, I'm showing you the fact sheet of the HDFC fund, as you can see here. So here, as you can see in MSCI, there's 67% allocation. And if you look at other indices, there's Equity Europe, Equity Japan, Equity Canada, Equity Ex Japan. These are the different allocations which are given to other indices. Okay. So after the fund of fund category that we've discussed, the next is the active international funds. So active international funds is where the fund manager is going to directly invest in international stocks. Okay. So here in the fund of fund, the fund managers are investing in other mutual funds of international mutual funds, but in active international funds, the fund manager is going to pick stocks on their own, and they are the stocks which are not going to belong to domestic markets. They're going to be stocks from foreign markets. Okay. So the a very classic example is your ICICI US blue chip equity fund, right? Now, what does that fund do? The fund invests directly in stocks of large cap companies which are listed in the US. Okay, and the name is quite it tells you what it does. So if you look at this fund, it is investing directly into US stocks, and it has been in existence since July 2012. Now, there are there are other two funds as well, which so of course these are the other examples. I'm sure all of you have heard of the Parag Parekh Flexi Cap Fund, right? Now, the Parag Parekh Flexi Cap Fund is an interesting fund because it is a fund that holds international stocks in its portfolio. So 35% of the portfolio of the Parag Parekh Flexi Cap Fund is invested in international stocks directly. Okay, so it is not investing 100% of the stocks in international stocks. It is investing only partly, which is 35% in international stocks. So I think I'm just going to show you. Yeah, so there's a breakup of the Parag Parekh Flexi Cap Fund in terms of where they have, in which are the stocks in which they have invested. Yeah. So that is why we also have another fund, which is Samco Flexi Cap Fund, which also follows a similar strategy as Parag Parekh, where there's a part of the portfolio which is invested in international stocks. Okay. Now, the third category is your passive international funds, which basically invest in index funds or ETFs of that particular country, or they could just invest in one particular mutual fund of a particular country, because then it means that there is no active fund management involved. Okay, which means the fund manager is passively investing. It could be in the index, it could be in just one particular fund, but there's no active fund management which is happening in these funds. Okay. So what is happening is that the money is collected directly from the investors, and it is invested into foreign equities or selected fund of a specific geography. But like I say, there's no active fund management. These funds, if it's an index fund, it's going to replicate the index of that particular country. So whichever index we've selected, that particular index is going to be replicated in these particular funds. And obviously, the objective is to take advantage of the market, right? So one argument is, why invest only in US markets, right? I'm sure a lot of you would have this argument. We are talking so much about US markets, but why only US markets? Why can't we look at other economies? Like, why can't we look at, China and other economies which are supposed to, do well in the future, and all of us talk about it, correct? So now what I'm going to do is I'm going to quickly tell you about China, and when we are looking at China, then what are the parameters that we can consider, right? So China is the second largest economy in the world, expected to be number one in the coming years, right? All of us know that. It is the largest manufacturer of automobile and mobile phones in India, and it has been the manufacturer for the developed countries for more than 2 decades now. So most of the developed countries are actually dependent on China for a lot of their manufacturing. Of course, we have the China plus one policy, which is coming, but it's not going to be easy to just shift out your production from China immediately, right? It's going to take a while. China obviously it has attributes of an emerging economy and a developed economy, which is a big benefit, right? So it has the benefits of both sides of the story. So if I just show you this chart, right? Just a minute. Okay. In the last 15 years, Chinese equities have outperformed Indian equities in a very, very crazy way. So in 2006, right, during 2006, the market capitalization of India and China were at similar levels. Okay, or maybe I would say China was slightly lesser than India in 2006. But today, if you see, market capitalization of Chinese equity is 5 times higher than India. So which means in the last 15 years, if you see, the market capitalization of Chinese equities have outperformed India, of course, but by 5 times. Okay. And when you were talking about these passive international funds, they basically take exposure in different international markets. And that is why one of those funds that we could look at is this one, which is your Edelweiss Greater China Equity Offshore Fund. So if you're looking to invest in a passive way in probably the Chinese market, then you have funds which are available. right? So you have funds which invest the corpus in JP Morgan Greater China Fund. So this fund, which is Edelweiss Greater China Equity Offshore Fund, is investing in a fund which is called JP Morgan Greater China Fund, but only in this fund. Okay, it is not investing in multiple funds. So that is why it's called a passive fund, because there's no active fund management. The fund manager is only investing in this particular fund. Okay. So see, the difference is in passive investing, there should be the fund manager's involvement is very limited, right? The fund manager is not doing active fund management. And that is why we call this fund as a passive international fund. What are some of the other funds in the passive category, right? So, okay, so maybe I'm not noted down in the presentation, but we have Motilal Oswal Nasdaq 100 ETF. Then there's Motilal Oswal S&P 500 Index Growth Fund. Then there's Nippon India Taiwan Equity Fund. There's Mirae Asset Hang Seng Tech ETF. And then there's HSBC Brazil Fund. So you have a lot of funds which are investing either in one fund of a particular geography, or they are investing in a particular index of a particular geography, right? So that is why these passive funds can benefit an investor. If of course I'm going to tell you how to select the fund as well, but these funds can definitely benefit the investor. So I do believe that depending on your investment preference, there are multiple options which are available to invest in international markets, and all these funds provide different opportunities that are available. So if we just look at investing now, let's look at how to really build a mutual fund portfolio around this, right? So ideally, when you are looking at your mutual fund portfolio, you have some exposure to international funds, not a very big exposure, but some form of exposure. So you could look at say 80 to 90% in terms of your Indian market, but to provide diversification, 10 to 20% could go into international markets in whatever form that you have, that you are convinced about. Could be it fund of funds, be it active international funds, or be it passive funds. But in whichever form, you could look at say 10 to 20% of your portfolio in international funds to really get the diversification benefit, which is extremely important in today's time. Yeah. Now, while selecting international funds, you should consider funds from developed markets and emerging markets. I would say that, of course, developed markets, you look at US and so on, but definitely look at an emerging market fund, especially China. By investing in China, we are, getting a good benefit, like I said earlier, because China has the benefits of emerging and developed markets. And yeah, and then between active fund, a feeder fund, or passive fund, you need to do your groundwork and to be able to decide where you want to invest. So will investing in international funds reduce the risk is the question, right? So let me just maximize the screen for you to show you this chart. So if you have to invest in international funds, would it reduce the risk? So 100% invested in domestic fund would generate a CAGR of 12.74%. So if you see the red line, that is what it shows, okay? So had you invested in 2013, you're looking at your returns in 2020. And if you had put 100% in domestic fund, you would have got a CAGR of 12.74% as of today, as of 2020. And if you look at the blue line, that's basically the asset allocation. So which shows, had you invested 80% in domestic equities, say in a flexi cap fund, and 20% if you'd invested international, you would have got a CAGR of about 14.6%. Now, obviously, this with diversification in international markets, your return expectation is also slightly going up, which is how we look at it, right? And which is what we want. So that is why whenever we are looking at investing in international funds, they tend to reduce our risk. They tend to give us slightly better returns. So why not, right? So which is why, like I said, about 10 to 20% of your portfolio could go into international investing. Now, what we're going to look at is the tax treatment. Now, this is a question that we get very often, and it is important that we talk about the tax treatment part, because a lot of people would assume that since we are investing in equities, the tax treatment is probably going to be same as equities, right? But that is not the case. So I'm going to quickly tell you how the tax treatment works in this category of funds and in equity funds in general. So if you look at equity funds, if you're investing in any equity fund in the domestic market, the tax treatment is, so basically as per the definition, 65% of the net assets should be invested in Indian listed equities only. So if you want to get benefit of the equity taxation, then 65% of the fund should be invested in Indian listed equities, correct? So which is why if you look at the Indian, had you invest in Indian equities, your tax would be 10% over and above 1 lakh in LTCG, which is long term capital gains. So which is after 1 year, if you're taking out your money, then 10% over and above 1 lakh. So you leave aside 1 lakh of gains and pay 10% on the remaining. And your short term capital gains in equity is about 15%, 15%. So on your gains, you pay flat 15%. Now, the problem is when you're investing in international funds, you are not investing in Indian listed equities. So, when you're not investing in Indian listed equities, then you don't get the benefit of equity taxation, then you have to pay non equity taxation, or we call it debt taxation. Now, what is debt taxation or what is non equity taxation? So, in this particular case, if your holding period is less than 36 months, which is less than 3 years, if your holding period is less than 3 years, then the capital gains tax is based on your tax slab. So whatever tax slab, marginal tax rate that you're paying, that much tax you'll have to pay. And we call it short-term capital gains in the case of debt. Now, if your holding period is more than 36 months, which is more than 3 years, then the tax that you pay, then it's called long-term capital gains. And then the tax that you pay is 20% with indexation. Okay, so indexation is basically inflation adjusted returns. And if you look at 20% with indexation, effectively it shouldn't be too far from 10% that we talk about in equity. So it's almost close to 10%. Okay. So, we keep saying that we should diversify our portfolio. We should not put all our eggs in one basket and, all the jargons that we use. But I truly believe that when you're looking at diversifying your investments in stocks and you're looking at investing in multiple companies, you're looking at investing in multiple stocks, we invest in gold, we invest in fixed income. We're doing all of that to manage our risk, correct? But today, even international markets provide us ample opportunities, and we should make use of those opportunities so that we can really diversify our portfolio and also better our returns, right? Which is also another thing that we should be looking at. And I think all thanks to technology today, we have all the flexibility to invest in international markets. So the question is, why not, right? So why not invest in international markets if today we have the benefit? So yes, so I think I hope you guys are able to understand in terms of what I was trying to explain in the international market space, and now of course open to questions. So feel free to send your questions, and I'll answer them to the best of my capacity. Okay, thank you, Rahul. Thank you so much. Okay. So Mukund Singh, I'm starting my investments. Can anyone suggest basic videos or articles where to start researching, getting knowledge about finance and investment? So Mukund, I mean, on the Groww channel, these master classes we've been doing for the last 7-8 months, you'll be able to get a lot of insights through all these master classes, because we cover different topics in every master class. So you can just go through the Groww Masterclass videos and you'll get a lot of information which will help you in getting started with your investments. Okay, I truly believe that we've created some really good content and you'll be really benefited if you go through those videos in detail. Okay. Okay. So guys, if you're going to ask me which fund should I invest in, is this good, is this bad, I will not be able to answer those questions. I would request you to limit the questions to concepts, limit the questions to any specific concept that you've not understood. Okay. Hi, sorry. I think there was some problem. I think all of you can now hear me. So Himal is asking, how should I invest, lump sum or SIP? So Himal, when it comes to investing through lump sum or SIP, completely depends on what works better for you. So if you think you have regular income and you can actually invest through SIPs, because SIPs, of course, bring in a lot of discipline, right? So of course you should be able to invest through SIPs if you want that discipline to come in, and at the same time if you have that regularity in terms of income. But at the same time, if you don't want to, if you just get a lump sum amount and you want to really invest that, then you could look at investing at one go. Now a lot of people believe that if the markets are down, if the market's up, what should I do? Should I time the market when I'm doing a lump sum investment? And of course that's a genuine concern, right? So then what you could do is, at the same time, what you could do is you could do an STP. So if you are worried about the market timing, but you have lump sum that has to be invested, then STP, which is a systematic transfer plan, is a good way of investing, where you could put your money, say, in a debt fund or a liquid fund, say, put that whole lump sum amount into a liquid fund, and then you could do, say, a particular amount STP, which is systematic transfer plan, into an equity fund at regular intervals. So it completely depends. Like I said, if you think the markets are really undervalued at this point, and at this point it's a good time to invest, then you could put lump sum. But if you are not sure in terms of market timing, and at the same time you have that regularity, then SIPs are definitely better, because they make use of the different market cycles and get you those average units, which are obviously good. Okay, active versus passive investment in mutual funds. So, Suresh, when we're looking at investing in mutual funds, of course, we have active funds. We have multiple categories of active funds that we look at investing, right? Your large caps, mid caps, flexi caps, multi caps, sectoral funds, thematic funds, multiple active funds which are available. A small allocation to a passive fund, so let's say to an index fund, is definitely a good thing to do, right? So it helps in terms of diversification. So you could look at a small percentage of your portfolio which could go into a passive fund, likes of an index fund, which would help you. And you could also look at, say, an international fund, which could help you. So the funds that we have discussed, these are good ways of diversifying your portfolio in mutual funds. Okay, I would say that we've done a lot of topics around mutual funds, which are going to give you the full detailed description about each of these topics and each of these concepts. You'll be able to definitely learn so much more. Okay. What are tax implications if I invest in directly in foreign equities? So, it's the same. It's a debt taxation that you have to pay, like I said, right? So it is very important for us to understand that you will get equity taxation only if you are investing in Indian or domestic equities, right? If you're investing in international equities, the debt taxation which I spoke about, which is less than 3 years, you pay as per your tax slab. Above 3 years, if your holding period is for long term, then you're looking at 20% with indexation. Why is the expense ratio so high in fund of funds? Okay, so see, fund of fund charge expenses over and above the underlying funds, right? So you have the underlying funds, and it's going to charge over and above that. So the expenses of these funds are generally higher than regular active funds, because they are investing those funds which so you're basically investing in another fund which has an expense ratio, so because of which it is basically an exponential increase in the expense ratio in that case. Okay, someone saying I'm 24 years old, earning 50,000 plus monthly salary, monthly saving of about 25,000. Okay, how can I reach my goal of 10 crores at the age of retirement? So, first I would say set aside some money for emergency funds. I'm sure you're already doing that. And if you're not, then please do set aside some money for emergency funds. Start an SIP into a basket of equity funds. So, when if you're looking at that 25,000 rupee investment, right? So, start an SIP into a combination of different equity funds, like so flexi cap, large cap, multi caps, and so on. And of course, aim to increase your SIP amount every year, which is very important, right? Don't just stick to the same SIP amount. Increase your SIP amount every year to be able to reach your goal. So these are some very simple things that you can keep in mind. Of course, in terms of how much, you have to do a detailed calculation. You have a lot of calculators which are available. You can do that calculation in terms of how much you need to start investing to reach your goal of 10 crores by the time you retire. But at the same time, it is important for you to understand that these simple, small things make a lot of difference, right? So having your SIPs in place, increasing your SIPs every year, and diversifying your portfolio by investing in different funds, not doing complete SIP in one fund, and so on. Okay. So yes, does Russia and Ukraine war will it impact the market, and is it the right time to invest? Okay, so of course it's going to impact the market. The crude oil prices have already gone up. We all know that, and when crude oil prices go up, it negatively impacts the economy, right? And we have a lot of dependence on crude oil. Yes, so any economy which is crude oil dependent is going to be impacted negatively. There is absolutely no two ways about it. We have already seen the impact, right? Markets are already in the process of correction at this point. So, like I was saying, Russia is one of the largest producers of crude oils, and with many Western countries now not buying crude oil from Russia, the prices are reaching its all-time peak or all-time high, right? And high crude oil price leads to higher inflation, and that's what is going to happen to Indian economy as well. We're going to see that. Okay, what is your views on Nifty 50 index and Nifty Next 50 index? Okay, so both are large cap indices, and it's good to have these funds in your portfolio. So these funds could be treated as your all season fund. So we spoke about all season category and seasonal funds. So your these kind of funds, Nifty 50 index or your Nifty Next 50 index, all these are your index funds, which can come under your seasonal all season funds category. Okay. Okay, what are the other questions that we have? Okay, so why foreign investors are investing in India, just like how we say that you should invest in foreign equities. If India is expected to be the next big thing, like we speak about China, right, which is a very big emerging economy. Similarly, for other countries, India is a very big emerging economy. We as Indian investors are already investing in domestic equities. We're already investing in the Indian markets because we understand that Indian markets are tapped to do well in the future, right? But when others want to make use of that opportunity, and that's the reason they are investing in India. Okay, how does AUM affect returns? So generally speaking, no. But in case of say mid and small cap funds, this might be a problem. Okay, because not all the fund managers would have many investable stocks in mid cap and small cap space, right? So the fund manager be able to identify good stocks, right? And if you don't have too many investable stocks in that category, then that could become slightly of a problem. So basically, if the fund size becomes really big, then fund manager would be forced to buy stocks even though they may not like it. Yeah. So there are instances where mid and small cap funds have stopped accepting fresh lump sum investments to avoid this scenario, because if the fund size grows, the fund manager has to invest more money in different stocks and there are no stocks available, then it could negatively impact the portfolio if they've identified wrong stocks, right? So which is why it could have some form of impact in the mid cap and the small cap space. In large cap, it's fine because most of the companies are investable companies, so it should be okay. Okay. Any other question? So again, if you guys are going to ask me questions related to a particular stock or a particular fund, I will not be able to answer that. Yeah, so any best plan for mutual fund? Guys, again, I say don't put all your expectation burden on one fund, right? Why do you want to do that? You might as well diversify, put your money in a basket of funds. Why put all your expectation on one fund? If the fund doesn't perform, you're going to be disappointed in terms of returns, right? So make sure that you're creating a basket of funds and you're putting your money in multiple funds to diversify your risk. Simple. So great. I think with that, we can end the session. I've taken a lot of questions today, and thank you so much, guys, for joining me today. I'm going to be doing the same session in Hindi at 12:30. So if you have, if you want to join in, please do. Thank you so much, and have a great weekend ahead. Bye bye.